Hey guys, so today I'm going to do something a little bit different than what I normally do, and I'm going to walk you through how I would think about analyzing a business. So for those of you who don't know me, my name is Matt Huang. I'm a current management consultant and a former investment banking analyst. And I make these videos because I like to, but also because I would have wished that somebody would have made these when I was a student. And today I'm going to talk you through my thought process when looking at a business. And we're going to focus on one company in particular, and I'll talk you through each step of the way and why I think the company is a good investment. So if you like the video, please subscribe, and also let me know in the comments any suggestions for content in the future. Let's get into it. So let's talk about the business first. So the company is named O'Reilly Auto Parts, and as the name suggests, they are a US-based automotive aftermarket parts retailer. And so what this means is that when your car breaks down, you're going to go to one of their physical locations and you can buy auto parts for your vehicle to hopefully repair your car. And they also sell to professional car mechanics as well. And one of the key things about this industry to know is that, well, first of all, it's retail, but it's different than traditional retail because it's more recession resistant, right? Because the key driver of demand in auto parts retail is going to be miles driven. Because the more miles that somebody drives, the more likely it is that they're going to have their car break down and that they're going to need maintenance, and therefore they will come and buy automotive aftermarket parts. The other thing that I think is important to consider is that to win in retail, broadly speaking, I would say you can bucket it into, three things that you really need to do well. The first thing being you need to get the right goods that people want to buy into your stores. So that means, superior supply chain management and also understanding your customer. Second is you really need to get people to come to your stores versus your competitors' stores if they're selling the same goods. And then the third thing is that you need to really have a way to keep your customers returning. And the way you do that is typically through either having strong brand loyalty or just a superior customer experience. So people, when they come to your stores, they have a good experience and therefore they want to come back next time. The second thing that I like to look at when analyzing business then is the competitive landscape. So when I think about who is competing against O'Reilly in the automotive aftermarket parts space, there's really a few names that come to mind. And they're known as the Big Four, which are O'Reilly, Advanced Auto Parts, AutoZone, and Genuine Parts Corporation. If you haven't heard of them, that's okay. All you need to know is that these four really compete head-to-head in the same market for the same customers. And then there are newer entrants that have recently entered the space, including Walmart and Amazon most notably. And of course, everyone is probably like, oh, watch out, Walmart and Amazon are coming in. And yes, they do pose a threat, but as I'm going to discuss in a bit, I don't think they're as big of a threat as people perceive. So then the third thing that I want to talk about is customer dynamics. And this is a very important thing that you should always look at when analyzing a business. And it's understanding who the customer base is and the different dynamics between the different customer groups that exist. So with O'Reilly, you can broadly segment the customer base into two segments. The first segment is going to be the DIY or do-it-yourself customers. And then the second segment is going to be the DIFM or do-it-for-me customers. Within the DIY segment, these are going to be people who are typically male, maybe a little bit lower income, who are going to want to repair their own vehicles rather than bringing them to a professional auto shop, either out of economic necessity or maybe they just have some know-how and therefore they want to repair their own car. On the DIFM side, these are going to be typically professional car mechanics and auto shops who are going to repair other people's cars for them. And so, as you can imagine, the needs for each of these customer groups is going to be slightly different. With the DIY segment, they're probably not going to be looking for the most complicated parts. Probably going to be looking for a better deal, to be honest. And then with the DIFM segment, there's going to be a much higher value being placed on a broader availability of parts and also the speed at which they can access these parts. Because if you think about it, if I'm a professional auto shop, an extra hour that my client's car is sitting in the shop because we're waiting for a delivery to arrive is an extra hour lost that I could use to repair somebody else's car. So now that we've talked about the business, we talked about the industry, we've talked about the competitive landscape, and we've talked about the customer dynamics, why do I think that O'Reilly is a good business? Well, I think it really boils down to three things. And the first is going to be just superior operational efficiency and supply chain management. The second is going to be extremely strong brand loyalty and very loyal customer base. And the third is going to be a increasing shift in the sales of the business from do-it-yourself revenue to do-it-for-me revenue. And follow me on this. Okay, so on that first point, which is extremely strong supply chain management, O'Reilly has a very robust method with which they manage the inventory at all their stores. And they use what's known as a hub and spoke distribution model, which means that they have stores that are called hubs, which coincidentally are also giant warehouses with tons of parts. And they're all within a very small radius of the spoke stores, which are the smaller stores that are around the hub store. And there are very frequent deliveries between the hub store, which acts as a distribution center, to the spoke stores. I believe a stat that was given by the company is that 50% of stores receive multiple deliveries in a single day. And the minority that don't receive multiple deliveries in a single day still receive deliveries 5 times a week. So that is incredibly frequent, and that's also why they're able to respond extremely quickly to changes in inventory demand, and also none of the stores ever run out of inventory. On the second point, which is extremely strong brand loyalty, O'Reilly has a really strong corporate culture, and I think it comes from their Midwestern roots. They're very, very focused on customer service, and as a result, the employees are very happy to work with the customers, and the customers feel that, and therefore they always want to come back, and they have a very, very loyal customer base. And that is something that is intangible, that is hard to replicate. And that's going to be a theme that I'm going to continue talking about, is things that are like difficult to replicate by competitors create a competitive moat for a business. And now the third thing that I mentioned was a mix shift from do-it-yourself sales to do-it-for-me sales. What this basically means is that it's not that the DIY segment is shrinking per se, but that the DIFM segment is growing very rapidly. And here's why I think that that is a positive for the company. Because although DIFM revenue is technically a little bit less profitable, it's lower margin than DIY sales. DIY is a market that is very, very crowded, and that Amazon and Walmart are now attacking. And so it's not an attractive place to be playing right now. Where the real competitive advantage is, I believe, is in DIFM revenue. And it's much harder to get into DIFM revenue because DIFM customers require, very fast delivery. And they also require very specialized customer service support from reps who really know what they're talking about, because you're talking with car mechanics. And the other thing is that the dynamics of the DIFM segment are such that all the mechanic shops will always have one supplier that they consider the first call. What that means is they will always go to you unless you happen to not have the inventory that they're looking for. So that's a very coveted position, and it's a very sticky customer base because these are very relationship driven, and therefore there's always going to be a preference for the car mechanic to call up his buddy at O'Reilly versus some random salesperson at AutoZone that he's never met. So O'Reilly is in the best position to be number one in the do-it-for-me segment because they are growing that much quicker than their competitors currently. And I think that's a smart strategic move because Amazon and Walmart can only compete in the DIY segment. The reason that they can only compete in the DIY segment is because Amazon and Walmart just don't have the auto parts know-how, and they don't have the expertise in auto parts retailing to be able to succeed with professional auto parts shops. So right now what they've been doing is they've been selling parts in the DIY space, and that is creating a major threat for companies that only play in that space. So again, the DIY segment is higher margin than the DIFM segment typically, but the DIFM segment is a much more difficult market to enter. And therefore, once you're in it, if you're in a good position, it's very hard to be unseated from that position. So now that we've established that O'Reilly is an attractive business and we think that their strategy is going to work out, how does this translate into a good investment? And it's one thing to say that a business is a good business. It's another thing to say that it's a good investment, right? Because especially in public markets, just because a business is a good business doesn't necessarily mean that it's a good investment, right? Because if a business is very high quality, oftentimes the market will recognize this, and then the price will appreciate to realize that value. And so that doesn't necessarily mean that you buying the stock means that you're going to make money. The best investments are made when the value of the company is up here, but then the price is down here because the market misunderstands the business or has overlooked something about the business that results in a mispriced security. And in the case with O'Reilly, I think that the market has definitely acknowledged the success of this business, and you can see it through their stock price. If you look at their historical stock price return, it just goes up and to the right. Now, why do I think that it's a good business? I think because the market is only slowly beginning to realize that this shift from DIY to DIFM revenue is a positive thing, because what basically happens is because DIFM is lower margin, it looks like the company is not growing margin as much as it should be, and that makes people concerned. But I think that over the long run, this is a successful move, and that once they're able to really solidify their position in the DIFM market, you will see margins recovering. That's just my thesis. I could be totally wrong, but if you had to ask me for my opinion on whether or not I think that this is a good investment, I would say that this is a very strong business, and I think there's even more upside than what the market is currently realizing because of this shift in the business, and I think that most investors aren't recognizing that this is a positive thing for the direction of the company. But anyways, I hope that this was somewhat helpful in giving you guys an overview of how I like to think about businesses and how I evaluate businesses, what sort of things I look for. I kept it pretty high level, but if you want me to make a future video that's more in the weeds of the actual numbers and things like that, let me know in the comments below. But otherwise, hope you enjoyed it and hope it was helpful.